We are continuing with our property transactions today, and this one will talk about dispositions of assets. And so it gets a little deep in areas, so you just have to hang there with me. You're going to be fine, but you just need to take it one little step at a time and just build on what you already know and just expand to this little broader concept. Okay, so we're reiterating at the very beginning here. We learned this in a previous chapter. When you dispose of an asset, you have to know how much was realized. In other words, how much did you get out of the deal, or your client. But when I say you, I'm talking about the people you're trying to do a tax return for. But in any case, the amount realized to the seller means how much was the sales price, basically. What did they get in total for the transaction? And so what you do is you take the amount of cash that came from the transaction, and if the only thing that happened is you sold an asset, or your client did, for a certain amount of money, then that is the amount realized. If there was no cost to you, there was no other assets besides cash, then it would just be the amount of cash that was transferred. That would be the amount realized. But that's seldom that simple. And so what you have to do is take the cash received and add that to the fair market value of the property that was received. And then you add to that any amount that of the seller's debt that was assumed by the buyer. So in other words, if you sold a property that was subject to a mortgage and you transfer the mortgage as well as the property, then that buyer is actually paying you the amount that was due on the mortgage because you were responsible for it. They're relieving it, your obligation from it. So that means they paid you for that mortgage. So those three things are the basis, the foundation, I should say, of the amount realized: the amount of cash you got, the amount of fair market value of the assets you got, and the amount of debt release that you got out of the thing. That's the three combined is the amount you realize. But you get to reduce the amount realized, in other words, lower the tax bill, by the cost you had related to it, like the selling expense. If you paid for the appraisal or the title search, you paid the commission to the realtor, whatever, that would, all those are considered selling expenses. So whatever selling expense the seller paid, you reduce the amount realized by those. And then you also reduce by any amount of the buyer's debt that the seller assumed. So if you traded property for property, and the property you assumed was subject to a mortgage, then similarly, when you take that property subject to a mortgage, you are giving that buyer a kickback, basically, by assuming the mortgage. So that reduces the amount you realize, of course, because you're on the hook for the mortgage. But in any case, so that doesn't happen as often, but it does sometimes happen, especially whenever it's trading properties rather than just outright selling one. But in any case, if the seller did assume some of the debt of the buyer, then that would reduce the amount realized. But then once you have this amount realized determined, this is how much I got for my property I'm selling, then you reduce that by your adjusted basis to come up with how much gain or loss you made. So the gain or loss is always going to be your realized gain or loss. The realized gain or loss is always going to be that amount you just realized, the amount realized being different from the gain realized. The amount realized is talking about the proceeds, the net that you got out of the deal. And so the amount realized minus your adjusted basis is what brings you to your realized gain or loss. So the adjusted basis, as we already know, this is just reiterating what we've already covered, but the adjusted basis is your initial amount you paid for the asset, plus any improvements you put into it. So cost of those improvements minus the depreciation you've already taken. That brings you to your adjusted basis. And that's sort of like what you think of in financial accounting as net book value. It's the tax basis, but it's similar to the same thing, as in it's the original cost plus any improvements minus any depreciation taken. Okay, and then to get to the gain or loss, as I said, that realized gain or loss amount of, this is how much gain or loss I had, the amount realized minus the adjusted basis. And that doesn't mean you're going to have to pay tax on that amount realized. That's just how much gain you definitely had for tax purposes. And then after you get to the realized amount of gain or loss, then you have to decide, is it time to recognize it or not? And so a recognized loss is just the amount of the realized loss, gain or loss, that is going to be recognized currently in this tax period. So recognized is the key to, is it taxable? Is it deductible? If it's a loss, if it's a gain and it's recognized, it means it's a taxable gain. If it's a loss and it's recognized, it means it's a deductible loss. So realized means it happened. Recognized means we have to put it on the tax return. Okay, now there's these different, the next piece is, we already kind of knew about that. We're just kind of making sure that foundation's still solid. And then after that, we're learning some nuances about gain or loss. So it matters what kind of character the assets are, about how the tax treatment of the gain or loss is going to fall out. And so the tax status is another term they use sometimes for the character of the gain or loss. But basically, there's three different treatments you would do depending on whether it is these three categories. That's why I say it's 1, 2, 3 in my notes. So we've got three sections: the ordinary assets, the capital assets, and the code section 1231 assets. Okay, so we'll start with the simple ones. We already know something about these first two. Ordinary assets are just not the capital gain treatment is not available. It's not capital assets, it's ordinary assets. And that would include your business assets that are for resale, like inventory. It could be other assets that are short term. In other words, hadn't been held for a year or more. So if they're held for a year, or I'm sorry, I'll get it right in a minute. If they're held for a year or less, they're still considered short term. So if you have an asset that you did hold a full year, you think of it as still on the ordinary assets, because capital gain happens in excess of 1 year. Okay, so so for 1 year or less assets, that would be ordinary assets. And so that would, even if they would have qualified as capital or trade or business, then they're going to be short-term ordinary if they're 1 year or less held. And then the gain or loss deductible is deductible at ordinary rates. No preferential treatment if you're an individual. And so that is important to know where that line is. If it's a short-term asset, or if it's a business asset, like an inventory item that you're selling that we use in your trade or business, then those are not eligible for any special treatment. Okay, so that's ordinary assets. Then capital assets are assets that are held for the production of income. They're not personal use. In other words, they're not strictly private. You're trying to make money on them. And they're not trade or business. So they're not your personal residence, and they're not business assets. There are other investments like stocks and bonds that you own, maybe even a piece of land you bought for investment purposes that you plan to resell. And so those kind of things, capital assets, are eligible for, if you're an individual, special treatment. So if you're an individual, or if your ownership is in a partnership or an S corp, then those benefits of capital gain can flow out through the entity back to you. So the general rule is, though, that long-term capital gain treatment gets better rates from 0 all the way to 20%, with 20% being the max that anybody's paying on what capital asset gain. And so capital loss says, on the other hand, offset capital gains, but they're limited in that you can only take a $3,000 loss per year. So if you have more than that in loss, you would just carry it forward, use it to offset some other gains, and then each year you could take a $3,000 loss on a carry forward of a long-term, of a long-term capital loss. And so any capital loss is limited to $3,000, long or short, but you combine them to use your $3,000 limit. And then once you have a $3,000 capital gain, capital loss of $3,000, then you can't take any more that year. You just have to carry it forward to offset gains in future years, or take the $3,000 loss until it's used up. Okay, and so that's for individuals. And then you net out the capital gains and losses, and that's what I kind of tangled a moment ago when I was talking about short-term and long-term, because it's not really very straightforward, but it is definitive. In other words, it's not intuitive, but it is definitive. So that means you can figure it out what the pattern is, but you just, off the top of your head, it just seem, oh, well, that's perfectly logical. That's exactly what I would have done. You just learn what the process is, and you go through that. Okay, so what you're going to do is you're going to calculate the short-term capital gain or loss. and you got to set that number aside. Then you're going to calculate the long-term capital gain or loss into 3 different categories. One would be the assets that are going to be taxed at 28% gain. And then the second group would be the assets that are at 25% or unrecaptured post Section 1250. And we'll talk about that some more. 1250 being the real estate assets. And then the third category would be 15% other long-term capital gain property. And so the 28% property is mostly talking about collectibles and small business stock gains, but mostly very few assets actually fall in the 28% bracket. But if it does, you have to segregate it. And then the unrecaptured 1250 property, we'll talk about that a little bit more when we get down to our third category, which is the business assets. We'll talk about 1231 and 1250 relating to these capital gains. But anyway, once you combine these long-term losses with the short-term long-term gains or losses with the short-term gains or losses, then if there's a net short-term capital loss, then you have to offset the highest rate capital gain first and then go down the line, which is good because that means your capital loss can offset the 28% gains rather than you have to pay tax on those higher taxable capital gains. And so if you have a leftover short-term capital loss, it's the only time you have to worry about that priority of which one's going to offset. If you wind up with a long-term capital gain rather than a loss or even a short-term capital gain, anything except a short-term capital loss, if you wind up with those, you don't have to worry about which order it goes in. So basically, you're still going to be limited to that $3,000, but after you combine, it's where you see whether or not you're going to deduct, be able to deduct all your losses, or you got to carry some of them forward. Okay, so we'll do a problem to demonstrate that, and it gets a little clearer when you put the numbers to it. All right, the next thing is there's a special exclusion of gain relating to this small business stock, and it's very intricate rule system, and we're not going to dig really deep into it. I just want you to know a general idea that there is this 5-year holding period, and 80% of the assets have to be active business asset and has to not be a service company. But I just want you to be aware and it on your radar that there is this special gain related to small business stock. So I'm sure you would recall we had that special loss related to small business stock that was for that faster deduction of the loss. Instead of limited to $3,000, you were limited to $50,000 or $100,000, depending on your married filing status or not. And so that was that Code Section 1244 stock. They gave us a preferential treatment for these small businesses. So likewise, on the gain side, there's also a preferential treatment for small business stock there. And so that's what this was talking about, that we don't see this in practice very often, but sometimes it does qualify. The reason I think I don't see it too much is because over the years, I've done a lot of service companies like doctors and lawyers and accountants. And so those don't qualify for the small business stock gain preference. And so if you have a company that does, though, you definitely need to be aware that that's a benefit you can offer your client. Show them how smart you are. Okay, now that's all individuals. If it's a corporation, there's no preferential rates, and capital losses can only offset capital gains, no other income, not even the $3,000. And capital losses, though, can be carried back 3 years if there's a capital gain back there and offset those to get you a refund if you're a corporation. And then they go forward for 5 years. So there is a benefit to being on the capital losses for corporations that is not there for individuals, and that's that 3-year carryback. And then capital loss carryback or carry forward is always considered short term, which when you're doing your groupings or whatever, which it doesn't make a whole lot of difference since we don't have the preferential treatment. But nonetheless, it is noted that it's considered short term. Okay, so that's the first two. We had ordinary assets, we had capital assets. Now we're going to talk about the 1231 assets. This is the new information that we haven't really covered very much because advanced tax. So we have to get into these more detailed what if this happened? All right, so 1231 assets is all the business assets. Under 1231, there's 1245 assets and 1250 assets. 1245 is talking about the assets that are not real estate. And then the 1250 is the real estate assets. So if you're talking about equipment, the machinery for manufacturing concern, that's 1245 property. Even automobiles, anything that's not real estate is going to fall under 1245. And then 1250 is talking about all the real estate. Okay, including the buildings. Okay, so assets used in a trade or business, including a rental, even a rental business, not just a active business like a grocery store or a nail salon or an accounting firm or a manufacturing company. Those are obviously business, and they would be 1231 assets. But also real estate assets are considered 1231 assets. So these rules that we're going to go through about recapture of depreciation, rather than showing them the gains on them as capital gain, those all apply to all real estate used in the trade or business, including rentals. Okay, so if an asset is used in a trade or business and held for more than 1 year, remember we talked about the fact that if it was not a long-term asset, it was not going to be considered as capital asset or 1231 asset. So the short-term assets automatically fall back under ordinary assets. So, but if it's held for more than a year, then those trade or business assets will fall under this code section 1231 with the subsections 1245 for non-real estate and 1250 for real estate. So 1231 gains have a special benefit. They're netted together, gains and losses, and they get the best of both worlds. When you put them together, if you have a gain, you get to treat it as a capital gain. So that's great. If you have a loss, you get to treat it as an ordinary loss, meaning it can offset other income from other sources. And so an ordinary loss or a capital gain, that's the beauty of code section 1231 gains or losses. So because of this benefit they're offering us, there's a lot of exceptions in the name of depreciation recapture. So rather than giving you capital gain treatment on all the gain of a business asset, they're going to make you recapture the ordinary income part that is tied to the depreciation you've taken on some of these different assets. So let's just go through it and see what we can do to get this to come clearer. And we're going to work problems that'll make it clearer too later. But first, let's just get the idea. The 1245 assets, the non-real estate assets, when you dispose of them, you recapture as ordinary income the accumulated depreciation that you've taken on that asset up to the amount of gain. So it's the lower of the gain on the sale or the accumulated depreciation, which means you're going to recapture all of the depreciation you've taken up to the amount of the gain. So in other words, you're not going to get any capital gain treatment on a 1245 asset until you've recaptured all of the accumulated. So basically, whatever you've depreciated, you will get to offset, you will have to pull in as ordinary income. And so the only way you get capital gain treatment on a 1245 asset is if you have a gain that covers your depreciation and also remains. So basically, it's when a gain is more than the amount you paid for the asset. That's going to be capital gain. So if you paid $100,000 for an asset, depreciated it for $80,000, and so you had a net book value of $20,000. So you got a net book value of $20,000. If you sell it for $60,000, then you're going to have a $40,000 gain. It's all going to be ordinary because you all had to recapture because you sold it for less than you had paid for it. So all the profit you're showing is some of your is indicative of the fact that you depreciated some of the assets. But if you sold that asset that cost you $100,000 and that you had depreciated down $80,000 worth of depreciation to get it to a net book value of $20,000, if you sold the asset for $130,000, then you would have $130,000 minus $20,000 basis. That would be $110,000 gain, and some of it would be ordinary up to the $80,000 depreciation, and the rest of it would be capital gain. So the capital gain treatment would be on the excess over 100. So if you had sold it for 130, then at 100, that the difference between 100 and 130 is a capital gain. But then all the rest of the gain is a ordinary gain. So selling it for an asset that has $110,000 gain, where 30 of it is capital, and then 80 of it is ordinary because 80,000 was the depreciation taken on the asset. So ordinary income up to depreciation taken, and any excess gain over that would be taxed at the capital gain rate. Okay, so that's 1245. Now 1250 is a little more complicated, to say the least. 1250, when it's sold, recapture, it sounds like it's very straightforward, except they kept adding a few more exceptions that caught them to catch you on the depreciation eventually. But in any case, let's just wade through it. When you dispose of a 1250 asset, you capture as ordinary income the lower of either the gain or the accumulated appreciation that is more than straight line. Well, so this is the basic recapture for 1250 property. So the real estate. So only the excess over straight line is caught in this first net of the 1250 recapture. And that means the current assets in the current environment, none would be recaptured under 1250 because we're calculating the depreciation and deducting for taxability the straight line method. Under the tables that we use straight line for the real estate. So since 1986, which is most assets in service right now, were put in service after 1986, but a few not, but a few earlier than that. But if you're still depreciating an asset from 1986, earlier than 1986, then you might have some recapture. Or if you have an asset you're selling that was depreciated back there, you also might have some recapture for 1250. But if you have current assets that have been serviced in the last few years that you sell, there won't be recapture in 1250 because you would have depreciated on straight line. Okay, then now, you also recapture as ordinary income all depreciation, even the straight line part, if the asset was held for 1 year or less. Of course, that's just the same ordinary income recapture that we already know about. Okay, so that is the standard basic 1250. It's too bad I can't leave it right there, because I can't. But that would make it cleaner if we could just think of the recapture on the two of them, just this. It's so logical compared to what we know. Just the excess over straight line is going to be recaptured as ordinary. Or if you didn't hold it for a year, that's ordinary. So that's good. And it's true. Those are, in fact, the basic 1250 recapture rules. Okay, but now we have this other one. Section 291 that applies only to the corporations says that when a corporation sells depreciable real estate, they recapture as ordinary income 20% of even the straight line part of the depreciation. So there would be that extra for corporations, 20% recapture under Code Section 12. Sorry, I'm just keep saying 291. Code Section 291 is making the corporations recapture 20% of the ordinary income, but not in excess of the gain. Whatever the gain is, you calculate that first, and then you say, well, let's see how much of that of the gain is represented by depreciation we had taken before. So whatever it is, you're taking 20% of that as ordinary, and the rest can still be treated as capital gain. And so then, of course, it's still the first calculation for 1250 is still in place, meaning on the real estate, meaning you still had to recapture anything that was over straight line rates. And then after you get to that point, even 20%, add 20% of the ordinary depreciation, even the straight line. Okay, and then any remaining gain that is not recaptured can be treated then as 1231 gain, meaning if it exceeds that original cost, just the same as 1250 when it exceeded 1245 when it exceeded the cost, that would be the capital gains rates. Okay, there's no capture needed on any of these if the sale turns out with a loss. If you have a gain, it's the only time you have to worry about this recapture as ordinary income. There's not going to be a special treatment on the loss. They're going to get that. If it's a 1231 asset, it's going to get that ordinary loss treatment. It's only whenever it's a gain that you have to worry about that. Okay, so that's that one. Now here we have this other one. So unrecaptured 1250 gains have a max tax rate of 25%. So they do have a preferential tax rate. But corporations' rate, as you know, is 21%. So it's not preferential for corporations. It's only preferential for individuals because 21% beats 25 any day, right? So we're just going to take a straight 21% for all gains in corporations. And then I won't say all, I'm sorry, you should never say all. But anyway, so for practical purposes, the normal rate is 21%. Unrecaptured 1250 gains for individuals though, maximum tax rate 25%. So that is unrecaptured code section 1250 gain is defined as lower of the gain on the sale or the accumulated depreciation, which would amount to the straight line depreciation. So the maximum rate they would have to pay would be on that recaptured would be 25%. So a small business that operates in it as a proprietorship, for instance, a lumber company. I had a client just a few years ago still running a lumber company under an individual Schedule C. And so that if he sold the company or some of the assets that are in the real estate in his company, then he would be able to take this 25% preferential rate, assuming his ordinary rate was higher than that. And so you'd look at the gain and say the maximum rate would be on this accumulated depreciation, because this is just the unrecaptured, not the part that had to be recaptured because of code section 1250 recapture or 291 recapture. Well, this doesn't apply to them because their rate's lower anyway. But so the 1250 recapture, that was for the excess over the straight line rate, that if you got hit by that, that part would be taxed separately. This unrecaptured is the part of the gain that was left, meaning the straight line depreciation part. And so that part would, the maximum you'd have to pay on that would be the 25% rate. So any remaining gain that is not unrecaptured 1231 gains gets normal favorable tax capital gain rates, 0%, 15%, and 20%, depending on where your ordinary rate is. So just to make this as complicated as they can, they had to just give us just a few nuances. But in any case, it is what it is. They don't ask us to make the rules. They're just trying to help us to understand them and explain them. So anyway, we'll see what we can do to get some of that to clear up with the problems. All right, here's some special rules because of the method of acquisition. So as we've gone through, there's been a lot of times where we had to talk about what is the basis of this asset, depending on where it came from. So just to keep in mind, these are just nuances that apply to these things we've just added. So if you got the asset by gift, there's carryover recapture potential. So these recaptures we talked about for the straight line, for the depreciation in full for 1245 property, for the straight line, the excess over straight line for 1250 property, even for the real property recap for corporations, for the unrecaptured 1250 gains, all those rules, those carryover provisions hold on with those assets when the assets are gifted. In the same way that the carryover basis comes in, the same as the donors for a gift, then they keep those same tax attributes. Meaning, if you sell an asset that was gifted to you, if it would have been recaptured by the donor, if they sold it, then it has to be recaptured as ordinary income by you too. So it carries over the characteristics as it comes to you, because that's the way basis works in gifting. All right, on the other hand, an inheritance, when you get something because someone died rather than while they were alive, then you get the assets at a stepped up basis. It's your basis. The new basis is the asset's value at the date of death usually. And so there's no, or 6 months later sometimes, but in any case, it's not the donor's basis. It's the basis on the fair market value at the day of the transfer or at the alternative date. So there's no risk of recapture in those. They get a reset just like they get a reset on the basis. The step up clears out the history and the characteristics that would have carried over if they had gifted it to you. That's for inheritances. And then non-tax transfer. If a gain is recognized on a trade or something, or like kind of exchange, then the part subject to recapture will be treated as ordinary income. And non-tax basis has carryover recapture potential, same as it was in the hands of the transferor. And so that would be too when you move it into a corporation, a 351 transfer, any of those kind of things we've had where a transfer from one to another is a non-tax event, then that would be a carryover basis, similar to what I mentioned on the gifting, where that characteristic goes with the asset. So if there's recapture trouble coming in with the asset, it means it's still there. Okay, and then there's this last trouble about this, I guess, I think. Maybe I've got them all. I think that's the last one, 1231 look back. All right, so if you get the benefit of this 1231 gain taxation and treatment as a capital gain, then you have to be cognizant of this potential bite you. And that is, if you have a gain, you have to look back. If you get treated as capital gain under 1231, you have to look back for 5 years. And if within that 5-year period, there's a net 1231 loss that was deducted, you must recapture as ordinary income any 1231 loss back through the 5-year period before you can treat it as capital gain. So, oh my gosh, just to complicate it further. So if you have a capital, a 1231 capital gain, you did get that preferential treatment. Congratulations, you made it that far. But look back 5 years and let's see if you were taking the benefit of 1231 loss within the last 5 years. And if you did, sorry, you have to recapture that part of your current year gain as ordinary and only get capital gain treatment on the excess over those 1231 losses you took in the past 5 years. So there you go. And of course, if it's a personal assets, there's generally no gain or loss on those. They're not taxable as a gain. They're not deductible as a loss if it's just a personal asset, like your personal car or some other asset, jewelry, that type of thing. So you don't have to pay tax on those, and you don't get a loss if you sell them at a loss. Most people do sell them at a loss because they don't have a way to depreciate them, so they're all still at the full original value. Just like if you had a personal car, you drive it off the lot, you try to sell it the next day, you're going to have a loss. IRS won't let you deduct that, and Congress won't either, because Congress is the one that sets the rules. All right, we're skipping a couple of sections. The section 8.3, we're going to skip all of that. Then we're going to skip section B and C of parts B and C of section 8.4. And the reason for that is some of that's covered in other places that we've already taken care of, and some of it is super specialized that I'm just not able to cover everything. So that's just a piece I chose not to take care of. But in any case, though, this chapter, complex, but not really rocket science. So you just have to make sure you keep segregated which assets are which and the rules that apply to each one, and you're going to be fine. But don't take it lightly, okay? Give it some time. We're going to work some problems and see what we can come up with to clarify some of this.